Ever dreamt of joining the Millionaires Club?
Mm.
Today we're diving deep into how you can make that dream a reality.
Okay.
We've got this article.
Oh, cool.
How much do I need to invest a month to become a millionaire?
Mm-hmm.
And let me tell you, it's got some surprising insights that
Wow.
might make you feel like $1,000,000 is closer than you think.
Interesting.
Yeah.
It's definitely an intriguing question.
Yeah.
And the article starts by setting the record straight.
Yep.
Being a millionaire isn't about swimming in a pool of gold coins.
Right.
It's about building a net worth of at least $1 million.
Okay, so think of net worth like your financial report card.
Mm-hmm.
It's not just about how much cash you have.
Right.
It's the total value of everything you own minus any debts you have.
Precisely. Your house, your investments, even that vintage comic book collection could all factor into your net worth.
So you're telling me my Beanie Baby collection might actually be worth something.
Yes.
But this net worth concept is a good reminder that building wealth is about the big picture.
Absolutely.
Okay.
And what's fascinating is that reaching $1 million net worth, it isn't just about bragging rights.
Right.
It's about financial security and freedom,
Yeah.
especially as you think about retirement.
Makes sense.
Yeah.
Now, the article dives into this concept of compound interest, which always seemed a bit like magic to me.
Really?
It's like your money is making more money while you sleep.
Oh, wow.
How does that even work?
Imagine a snowball rolling down a hill.
Okay.
It starts small,
Oh.
but as it rolls, it picks up more snow, getting bigger and bigger.
Yeah.
Compound interest is kind of like that.
Okay.
Your initial investment earns interest, and then that interest earns interest,
Yeah.
creating this amazing snowball effect.
So the longer the snowball rolls, the bigger it gets.
Definitely.
No wonder everyone says starting early with investing is so important.
The article has this great example.
Okay.
If you invest $500 a month
Okay.
with an average annual return of 8%, after 30 years, you'd have over $745,000.
Wow.
But if you keep going for another 10 years,
Okay.
that same investment grows to over $1.5 million.
That's incredible.
It's the power of time working in your favor.
Okay, that's a serious incentive to start investing ASAP.
Yeah.
But what if you're not in your 20s anymore?
Mhm.
Is it still possible to catch up?
It's never too late to get started.
Okay.
The key is understanding how much you need to invest based on your age
Okay.
and how long you have until you want to hit that $1 million mark.
So it's all about finding that sweet spot
Yes.
between time, investment amount, and potential returns.
Exactly.
And the article lays this out with 3 different scenarios,
Yeah.
which might be helpful for our listeners to visualize this.
Right. So let's say you're 20 years old
Okay.
and want to be a millionaire by the time you're 60.
Mm-hmm.
That gives you 40 years for your investments to grow.
4 decades of that snowball effect.
Yeah.
That's got to add up.
Yeah.
So how much would you need to invest each month in that scenario?
Well, assuming an average return of 8%, you'd only need to invest about $285 each month.
Less than $300 a month to potentially become a millionaire.
Yeah,
That's pretty incredible.
it is.
Now, what if you're starting a bit later?
Okay.
Say at 30.
In that case, you'd have 30 years to reach your goal.
Okay.
With the same 8% average return, you'd need to bump up your monthly investment to about $550.
Okay.
Still very achievable,
Yeah.
but you can see how those extra 10 years in the first scenario make a difference.
Time really is really when it comes to investing.
It is.
Now, let's look at the final scenario.
Okay.
Someone starting at age 40.
With a 20-year time frame, you'd need to invest around $11,175 each month to reach that $1 million goal,
Okay.
assuming the same 8% average return.
So the later you start, the more you need to invest each month.
Right.
But the point is, it's still possible to become a millionaire,
Right.
even if you're not starting in your 20s.
Absolutely.
Okay.
It just requires a little more strategic planning.
Now, before we jump into those specific investment strategies,
Okay.
let's take a moment to talk about the different ways you can invest your money.
Mm-hmm.
The article highlights some popular options, and I think it would be helpful to unpack each one,
Sure.
so our listeners can get a better understanding of what might be a good fit for them.
There's definitely no one-size-fits-all approach when it comes to investing.
Right.
Your best option depends on your risk tolerance, financial goals,
Yeah, okay.
and how much time you have to invest.
Right. So let's dive into these different investment options.
Okay.
I think a lot of people hear about the stock market and immediately think of Wall Street, those flashing ticker symbols,
Yeah.
and maybe even a bit of fear.
Right.
But stocks have historically been a pretty solid way to build wealth, haven't they?
They definitely have.
Yeah.
Historically, stocks have yielded an average return of 7–10% per year.
Wow.
even factoring in inflation. But the article makes a good point about remembering that past performance isn't a guarantee of future results.
That makes sense.
Yeah.
So what should people keep in mind when it comes to investing in stocks?
Well, it's important to understand that investing in individual companies can be volatile.
Okay.
A company's stock price can fluctuate quite a bit in the short term.
So how do you avoid getting caught up in those short-term ups and downs?
Right.
I've heard the term diversification thrown around a lot,
Yeah.
but I'm not always sure what it means in practice.
Diversification is like building a strong foundation for your investment portfolio.
Okay.
Instead of putting all your eggs in one basket,
Right?
you spread your investments across different companies' industries and even geographic regions. This helps to reduce your overall risk.
So if one company or sector isn't performing well,
Yeah,
your entire portfolio isn't tanking,
exactly.
I'm starting to see how this diversification strategy works.
And if you're looking for a simpler, more diversified approach to stock investing, the article suggests considering index funds and ETFs.
Okay, I've heard those terms before,
Yeah.
but honestly, I'm a bit fuzzy on the details.
Yeah.
Could you break them down for me?
Sure.
And maybe for our listeners who might be in the same boat.
Absolutely. An index fund is basically a type of mutual fund
Okay.
that tracks a specific market index like the S&P 500. Imagine it like a pre-built basket of stocks
Okay.
that mirrors the performance of that particular index.
So instead of trying to pick individual winning stocks,
Yep.
you're investing in a broad slice of the market.
Exactly.
Okay.
And ETFs, or exchange-traded funds, are similar to index funds
Okay.
in that they also offer diversified exposure to a particular market segment. The main difference is that ETFs are traded on stock exchanges, just like individual stocks,
Okay.
while index funds are typically bought and sold through mutual fund companies.
Okay, so both index funds and ETFs can be good options for those who want to get into the stock market without having to pick individual stocks.
Exactly. Plus, they usually have lower fees than actively managed mutual funds,
Oh, that's good.
which is a nice bonus.
Lower fees diversification?
Yeah.
Sounds pretty good to me.
Yeah.
Now, the article also mentions real estate as a way to build wealth. This one always intrigues me because it seems so tangible.
Yeah.
You're investing in something you can actually see and touch.
There's definitely an appeal to that.
Yeah.
And real estate has the potential to appreciate in value over time.
Okay.
Plus, you can generate passive income by renting out the property.
So you could have a tenant helping you pay down your mortgage
Exactly.
while your property is potentially increasing in value.
Yeah,
That's a pretty sweet deal.
it can be.
Yeah.
But it's important to remember that real estate often requires a significant upfront investment
Yeah, that's a good point.
compared to, say, buying stocks or index funds.
Real estate isn't as easy to get into as some other types of investments.
Right. But it can offer some unique benefits,
Oh.
particularly if you're looking for diversification beyond just stocks and bonds.
Speaking of bonds, the article mentions those as a more conservative investment option. Can you tell me a little bit more about how bonds work?
Think of bonds as loans that you make to a government or a corporation.
Okay.
When you buy a bond, you're essentially lending them money, and they promise to pay you back with interest over a set period of time.
So it's less about potential growth and more about steady, predictable returns.
Exactly. Bonds tend to be less volatile than stocks,
Right.
which makes them attractive to investors who are closer to retirement
Mm-hmm.
or have a lower risk tolerance.
Yeah.
But the trade-off is that bonds generally offer lower returns compared to stocks.
It seems like finding the right balance between stocks and bonds is all about finding your own personal comfort level with risk.
Exactly.
Now, before we move on, the article does briefly mention some other investment options like mutual funds, peer-to-peer lending, and REITs.
Yes. And while those are interesting avenues, they might be a bit too niche to dive deep into today.
Right.
We want to make sure we cover the basics
Yeah.
that are relevant to as many listeners as possible.
I think that's wise.
Yeah,
But it's good to know that there are other options out there for those who want to explore further.
exactly.
So we've talked about these different ways to invest your money,
Right.
but how do you know how much you should be investing each month? I mean, we all have different incomes, expenses, and financial goals.
That's where things get a little more personal.
Yeah.
And the article stresses the importance of creating a budget
Okay.
and tracking your spending. It's amazing how much money can slip through the cracks
Yeah.
when you're not paying attention.
I can definitely relate to that.
Yeah.
Until I actually sat down and wrote down all my expenses,
Well,
I had no idea where all my money was going.
it can be eye-opening.
Yeah, it is.
And once you have a clear picture of your income and expenses, you can start identifying areas where you can potentially cut back or save more.
So it's about making those small conscious choices.
Exactly.
I can free up more money for investing.
It is.
I like that approach.
It's all about finding what works for you and your lifestyle.
Now, I'm guessing that setting realistic investment goals is also a big part of this process.
Absolutely.
Yeah.
And it's important to factor in other financial goals you might have.
Okay.
Like saving for a down payment on a house, paying off debt,
Right.
or even planning a dream vacation.
Yeah.
Investing should be a part of your overall financial plan,
Right.
not something that competes with your other priorities.
That's a great reminder. You shouldn't feel like you have to sacrifice everything else to reach that $1 million mark.
Exactly.
It's about finding a balance that works for you.
Exactly.
And as you progress in your career and your income grows, it's a good idea to gradually increase your investment contributions over time.
Yeah.
Even small increments can make a big difference in the long run. So it's about building those good financial habits early on and adjusting as you go.
Right.
That makes a lot of sense.
Yeah.
Now, let's be honest, even with the best intentions, it can be tough to stay motivated and on track with investing. Life happens. Unexpected expenses pop up, and the market can be unpredictable.
Consistency is key.
Yeah.
And luckily, there are some really helpful strategies to keep yourself on track.
I'm all ears. I need all the help I can get when it comes to staying disciplined with my finances.
One of the most effective strategies, and one that the article highlights, is automating your investments.
I've heard about this. It's like setting it and forgetting it, right?
Exactly.
Okay.
You could set up automatic transfers from your checking account to your investment account each month.
Okay.
It takes the guesswork out of it and helps you stay consistent even when life gets busy.
I love that idea.
Yeah.
No more excuses about forgetting to invest.
Right.
It just happens automatically.
And another helpful strategy is to reinvest any dividends you receive.
Okay.
If you're investing in stocks that pay dividends, you can choose to have those earnings automatically reinvested back into your portfolio.
Oh, okay.
This can really compound your growth over time.
So it's like earning interest on your interest.
Exactly.
That's a pretty powerful concept.
It is. But even with automation and dividend reinvestment, it's important to remember that your investment journey isn't a set-it-and-forget-it endeavor.
Right.
You'll want to review your portfolio periodically, maybe once a year or so, to make sure your investments are still aligned with your goals and risk tolerance.
So it's about finding that balance between automation and staying engaged enough to make adjustments when needed.
Exactly.
What are some of the things you should be looking for when you do those portfolio checkups?
It's a good idea to assess how your investments are performing, make sure you're still comfortable with the level of risk, and consider rebalancing your portfolio if needed.
Rebalancing. What does that mean exactly?
Rebalancing is essentially adjusting the mix of your investments to maintain your desired asset allocation. For example, if you started with a portfolio that was 70% stocks and 30% bonds, but the stock market has performed exceptionally well, you might find that your portfolio is now 80% stocks and 20% bonds.
So you'd want to sell some of your stocks and buy more bonds to get back to that original 70-30 split.
Precisely.
Okay.
Rebalancing helps ensure that your portfolio stays aligned with your risk tolerance and long-term goals.
This is all great advice.
Thanks.
Now, I know we've talked about setting realistic expectations and understanding that investing comes with some level of risk.
Right.
But are there any other factors we should be aware of?
Well, the article mentions a few other important considerations, like market volatility, inflation, taxes, and fees.
Okay, let's unpack each of those.
Okay.
Let's start with market volatility. I think we've all seen those headlines about the stock market going up or down, sometimes dramatically.
Yeah.
How do you navigate those fluctuations without panicking?
Market volatility is a natural part of investing.
Right.
Stock prices go up, they go down.
Yeah.
It's the nature of the beast. The key is to not let those short-term fluctuations derail your long-term goals.
Easier said than done sometimes.
Yeah.
But I guess it's all about perspective, right? Focusing on the long game rather than getting caught up in those daily or even weekly ups and downs.
Exactly.
Okay.
Investing is a marathon, not a sprint.
That's a good analogy to remember.
Yeah.
Now, what about inflation?
Okay.
I hear that word thrown around a lot, but I'm not always sure I fully understand what it means in the context of investing.
Inflation is basically the rate at which prices for goods and services increase over time.
Okay.
And when prices go up, your money doesn't buy as much as it used to.
So if your investments aren't growing at a rate that outpaces inflation, you're actually losing purchasing power over time.
Exactly.
Okay.
That's why it's so important to aim for returns that exceed the rate of inflation.
Mm-hmm.
If inflation's at 3%, for example,
Right.
you want your investments to be growing at a rate higher than that, say 5% or 6%,
Yeah, okay.
to actually be increasing your wealth.
It's not just about earning returns, it's about making sure those returns are keeping up with the rising cost of, well, everything.
Exactly.
And finally, let's not forget about the impact of taxes and fees on your net investment return.
Right.
Ah, yes. The dreaded taxes and fees.
Yeah.
It seems like they always manage to take a bite out of any profits you make.
They could definitely eat into your returns if you're not careful.
Yeah.
That's why it's so important to choose low-cost investment options.
Okay.
And to explore tax-advantaged accounts like a Roth IRA.
Mm-hmm.
These can help you minimize the impact of taxes and fees on your overall returns.
This all sounds a bit complicated.
Yeah.
Is it worth talking to a financial advisor to get personalized advice on all of this?
It can be very helpful, especially if you're new to investing.
Right.
Or if your financial situation is complex.
Yeah.
A financial advisor can help you create a customized investment plan.
Okay.
That takes into account your individual goals, risk tolerance, and tax situation.
I think that's great advice for anyone who's feeling overwhelmed or unsure about where to start.
Yeah.
Having a professional in your corner can make a big difference.
Absolutely. Now, before we move on,
Mm-hmm.
do you have any key takeaways so far from our discussion?
You know what stands out to me is how achievable becoming a millionaire really can be.
Yeah.
Especially when you break it down into these manageable steps.
Mm-hmm.
It's not about some secret formula or get-rich-quick scheme.
Right.
It's about making informed choices,
Yeah.
starting early, if possible, and
Yeah.
staying consistent over time.
I completely agree.
Yeah.
It's about building those good financial habits and weaving investing into your overall financial plan.
And I appreciate how the article provides actionable advice that anyone can apply to their own situation. Yeah.
It's not just about theory, it's about practical steps you can take today to start building a brighter financial future.
Absolutely.
Now, I've covered a lot of ground,
Yeah, we have.
but there's still one crucial piece of the puzzle we haven't explored yet.
Sure.
How to actually calculate that monthly investment amount you need to reach your goal.
That's a great point.
Yeah.
And luckily, the article provides a simple step-by-step guide to help you figure that out.
Perfect. So why don't we take a quick break and then jump into those calculations when we come back. All right, we're back and ready to tackle the million-dollar question.
Okay.
Literally, how do you actually calculate how much you need to invest each month to reach that magic number?
The article breaks it down into a really straightforward process.
Yeah.
And it all starts with understanding 3 key variables.
Right.
Your time frame,
Okay.
your expected rate of return, and the magic of a compound interest calculator.
Okay, so let's break those down one by one.
Sure.
First up, time frame.
That seems pretty straightforward.
Yeah.
It's how long you're giving yourself to reach that $1 million goal, right?
Exactly. Are you hoping to hit it by 50, 60? Later. The longer your time frame,
Right.
the less you'll need to invest each month.
Okay.
Thanks to the power of compounding we talked about earlier.
Makes sense. More time for that snowball to roll and gather momentum.
Exactly.
All right, so next up is the expected rate of return.
Okay.
I'm guessing this is where those different investment options we discussed come into play.
You got it.
Okay.
Your expected rate of return will depend on the types of investments you choose.
Right.
Remember, stocks tend to have the potential for higher returns than bonds, but they also come with more risk.
So finding that balance between risk and potential reward is key.
It is.
And I imagine this is where doing your research and maybe even consulting with a financial advisor can be really helpful.
Absolutely. It's all about finding investments that align with your comfort level and your overall financial goals.
Right.
But once you have a reasonable estimate for your rate of return, you can plug that into a compound interest calculator along with your time frame.
Now, I've seen these calculators online,
Yeah.
but I'll admit I've never actually used one.
Okay.
Are they really as simple as they seem?
They really are.
Okay.
You just input your starting amount, your monthly contribution, your expected rate of return, and your time frame.
Okay.
And boom, the calculator shows you how much your investments could potentially grow over time.
It's like a financial crystal ball. Now let's put this into practice.
Okay.
The article gives an example, and I think it'll help make this whole calculation thing click for our listeners.
Great.
Let's say you're 30 years old.
Okay.
And want to become a millionaire by 60. So you have a 30-year time frame to work with.
Right.
And let's assume you're aiming for that average 8% annual return we talked about.
In that scenario,
yeah,
the calculator would show you that you'd need to invest about $550 each month to reach your goal.
Wow, that really drives home how attainable this can be.
Right.
Consistent investing, even with moderate amounts, can really add up over time.
Exactly. And the beauty of these calculators is that you can play around with the numbers.
Yeah, that's cool.
What if you could bump up your monthly investment to $600? Or what if you started investing at $25 instead of $30?
Right.
Seeing those different scenarios can be really motivating.
It's all about finding what works for you and your circumstances.
Exactly.
Now, I know we've covered a ton of information today.
Yeah.
But before we wrap up, I thought it would be helpful to address some of the common questions people have about becoming a millionaire.
Right.
The article touches on a few, and I think they're worth revisiting.
Great idea.
So the first question is a classic.
Okay.
How much must I invest monthly to reach $1 million by retirement?
And as we've been emphasizing through this deep dive, there's no magic number that applies to everyone.
Right.
It all comes down to those key variables. Your starting age, your expected rate of return, and how long you have to invest.
Right. So the earlier you start, the better.
Yeah.
But even if you're starting a bit later, it's not impossible to reach that goal.
Exactly. It just might require some adjustments to your investment strategy or your monthly contributions.
Now, another question that comes up a lot is about the average rate of return for stock investments. What's a realistic expectation?
Historically, the stock market has delivered an average annual return of 7 to 10%.
Okay.
Adjusted for inflation. But it's crucial to remember that past performance doesn't guarantee future results.
So while it's good to have that historical context, it's important to stay informed and adaptable.
Yeah.
Especially in today's ever-changing economic landscape.
Absolutely. Now, here's a question. I think a lot of people in their 40s and beyond might be asking themselves, is it too late for me to start investing and become a millionaire?
I'm sure this is a concern for many people who feel like they've missed the boat. What would you say to those who are feeling discouraged?
It's absolutely not too late.
That's good.
The key is to not let that feeling of being behind hold you back.
Right.
You might need to invest a bit more each month or explore investment options that have the potential for higher returns, but it's definitely still possible to reach your goals.
So it's all about adjusting your strategy and focusing on what you can control.
Exactly.
Now, we talked a bit earlier about index funds and ETFs.
Right.
But could you remind our listeners what the main difference is between the two?
Both offer a diversified way to invest in the stock market.
Okay.
But ETFs are traded on stock exchanges like individual stocks, while index funds are typically bought and sold through mutual fund companies.
Great. That's a helpful distinction to remember.
Yeah.
And finally, let's revisit those key tips for staying on track with your millionaire investment goal.
Automate, automate, automate. It's the best way to ensure you're consistently investing.
Yeah.
Even when life gets hectic. And remember to reinvest those dividends to harness the power of compound growth.
Right.
And lastly, review and adjust your portfolio periodically to make sure it's still aligned with your goals and your risk tolerance.
It's all about setting yourself up for success and staying proactive.
It is.
Well, I think we've covered just about everything today.
I think so, too.
Is there any final thought you want to leave our listeners with?
You've heard how achievable becoming a millionaire can be.
Yeah.
It's not a pipe dream reserved for the wealthy few.
Right.
So the question I'll leave you with is this.
Okay.
What one step can you take today to start building your own path to wealth? Maybe it's setting up a budget, opening an investment account, or simply educating yourself further about different investment options. Whatever it is, take that first step and watch your financial future unfold.
That's great advice. And remember, you don't have to do it all at once.
Yeah.
Even small, consistent steps can lead to big results over time. Thanks for joining us on this deep dive into the world of millionaire investing.
It was my pleasure.